You're kind of the Michelangelo and Leonardo da Vinci of the industry, right? And I will say who's who.
Well, I actually have a feeling about that. He's the architect.
There you go.
Yeah. So those Treasury papers that he put out at the very start of the administration, laying out sort of a whole series of broad views of financial regulation, really serves as the architecture for what a lot of us at the various agencies are doing. So I give him full architecture credit for that.
Well, and I agree. And let me say, both of you are here while I've got you. You've both indicated you're departing soon. I don't know your exact dates, and you may have announced that publicly or not. I don't know. But I want to thank you for what you've done. You really have been two leading lights in this town, that sometimes gets distracted by politics and various other side discussions. You came in professional, very focused. You went straight to work, and what you produced was world class. And so I never doubted that you would, but in fact, it really was fabulous work. Yeah. And I think it's going to set the stage for what we do for a very long time.
So without getting political, I'm not aware of any other administration that's come in and laid out a really blueprint to their approach to market regulation, to prudential regulation, to financial market oversight the way this one did with the work that Craig did at the Treasury. And if you look at what the agencies have done in the last 2 years, it's very much followed that roadmap.
And so I'll start with you, Craig, on your fabulous. So maybe you could tell us a little bit about your various reports. At the end of this process, how do you sum it up? But the FinTech report was one of the ones you did. What drove you to that particular report? How did you frame it? And then how do you think about it coming out of the several years you've been in the job?
Sure. Well, I now don't know what to do after I leave, as I need to go back to school after your introduction. I realized I didn't know any of that stuff, so I've got a lot to learn. But, as I appreciate the kind words also, and Secretary Mnuchin really prided himself when we did the work under the executive order to do outreach. And the assignment President Trump gave us was to look at the financial system under the core principles. And these are things such as access to products, making our companies competitive, avoiding taxpayer bailouts, but also making regulators and regulation more accountable, transparent, and effective. And so you really couldn't do that work without sort of surveying those regulators. Not to say you agree with everything you heard, but you had to really survey it. I found that Chris Giancarlo, the CFTC, had already started on this mission of modernization of his agency and thinking about these same issues. We did a report on banking and credit unions. We did a report on capital markets with all the different markets, and we did a report on insurance and asset management. And the reason we did the fourth report on, which is titled Non-Bank Financials, FinTech, and Innovation, was that through those first three studies, we found that there was a lot going on with data, technology, and evolution that we weren't really covering because we weren't really looking at that as a class of issues, and it deserved its own report. And that's in the innovation category, that there's tremendous opportunity for innovation, but you have to capture it, describe it, and study it. So that was really one reason that we wanted to collect in the fourth report. The second reason was that regulation had driven a lot of business activity, lending, trading, and other things, out of the regulated sectors of banking, insurance, and asset management into less regulated or differently regulated sectors. So non-bank financials might be more of a traditional company, a fintech might be more of a sort of internet-based platform, but both sort of had larger and larger market share. So it deserved to be covered because it was relevant really to how regulation should approach that and how it should be a level playing field. And finally, what we came to find, and I think Tim spoke to it and Brad spoke to it in the introduction, is what has started as a disruptive movement of sort of replacing traditional companies has now moved into sort of a collaboration. So one of the big topics is how can new technologies partner better with existing and mature regulated entities. And so a lot of our report is really talking about the level playing field, federalization of regulation, coordination with state regulations, and how do we allow mature companies to partner with new technologies and new companies. So all those things came together to justify a fourth and final report, which we're really glad we did.
And I'm going to come back to the report, but I want to also turn to you. You've talked about being a 21st century regulator, but you're more than that. Both of you have been real intellectual leaders. What does it mean, a 21st century regulator? How do you...
Yeah, I've talked a lot about it, and I've tried to recently articulate really what does that mean. And it has a number of factors, but the very first one is what I call adopting an exponential change mindset. And that is, as a regulator, to build into everything we do and everything and how we approach everything, the notion that we live in a time where Moore's law has created a degree of exponential rate of innovation, an exponential rate of adoption. And we've seen our markets in a very short period of time go from human markets to algorithmic markets, from analog to digital. And all of the changes you mentioned, it's almost like looking at the ocean and seeing the same ocean, but underneath the entire structure is giving away to new forms, new market structure, new innovation. And as a regulator, we have to anticipate that in everything we do. Now, at the CFTC, we're historically a principles-based regulator, and I think that gives us an advantage in having an exponential approach. We have to approach our principles in a way that accommodate new changes. So that's number one. The second thing is we've developed an internal innovation stakeholder. We call that, it's Lab CFTC. And it has both an outward-looking function and an inward-looking function. When innovators now come to us, they come to us through the office of Lab CFTC, which is stocked with people that are themselves intellectually familiar with the innovations, have written some excellent paper, they're thoughtful people, and they can speak the language of innovation and understand. And they don't sit in Washington and let innovators come to them. They meet with them in New York, in Chicago, in Silicon Valley, in Austin, Texas, in Singapore. We do CFTC lab hours around the world, in London and elsewhere, because we want to go where innovation is happening. That's the outward focus. Then the inward focus is they translate that in a way that traditional regulators can understand within our agency, but also on Capitol Hill. They are, in a sense, an internal disruptor. Their job is to get into the grill of our traditional regulators and say, yeah, that's fine, you're looking at the statute the way you've looked at it for 30 years, but guess what? This innovation is going to change that. And so we need to start thinking internally about how we interpret an 80-year-old statute with these new innovations. And then the third element of our becoming a 21st century regulator is moving in the direction of what I call quantitative regulation. We take in enormous amounts of data at the CFTC, and I know we'll talk about that this morning. But how do we analyze that? We need to move ourselves from an analog human-based analyzer of data to an automated AI, machine learning-driven way that we analyze enormous amounts of big data. And so we are, with the help of Congress, increasing our funding, moving. Our aspiration is to be a firm that can analyze data on par with Amazon and eBay and others in terms of how we look at data and how we look at big data movements as part of our market oversight, but also as part of our policy development. If we're going to evolve on a principles basis our policies for a new digital market, we need to be able to do it on basis of core key data and core analytics.
And for both of you, what kind of response did you get from Capitol Hill? You have committees you have to stand before. You still have to spend time on Hill, sort of holding hands. There's a lot of skepticism, a lot of concern. The industry's kind of run amok again. How do you help them get comfortable with both the concept of principles-based and let the industry innovate as well as the innovation itself?
Well, I'll just give you a quick answer and then turn to Craig. The CFTC, for historical reasons, reports to our ag committees. And when I would meet with representatives from some farming districts that are, themselves personally not on the cutting edge of technology, but they would say to me that their ag farmers come to them and say, what's going on in our markets? Are we being run over by algorithms? It used to be the head of the CFTC would say, I don't know. What I say to them is, I want to know. I want to answer that question. Give us the tools so we can understand the changing dynamics of markets to make sure these markets, as digital as they're becoming, can still serve the needs of your farmers and ranchers to hedge their agricultural risks.
But I would say agriculture probably gets it more than anyone else because of the need to use financial instruments to hedge against risk.
I mean, people don't understand it. Our ag commodity derivative markets are major export products in the United States. The reason the world trades agricultural products in US dollars is because they can be hedged in US dollars in US markets. The reason the world buys and sells commodities in our currency, which is a huge national advantage over farmers and ranchers and commodity producers the world over, is because of our functioning derivative markets. The price for commodities is not set in cash markets. It's set in our Chicago trading markets for derivatives.
I was just in Beijing a few weeks ago asking this question, at what point will the Chinese have similar markets, because certainly they need to hedge and manage the agriculture production much better than in the past. But Kurt, you spend a lot of time dealing with members of Congress. You're there, they're coming to see you. How do you allay their concerns, their fears about letting the industry, a regulated industry, we spent years putting them in a box, putting us in a box. How do you allay their fears about letting us innovate and compete with non-banks, but also provide customers with the kind of product that they want?
Well, particularly on the Hill, but also with the regulators, I think what we are dealing with is almost a lost decade. So you had the financial crisis. And as we emerged from the financial crisis, when Dodd-Frank was passed, your mature companies, your banks, your insurance companies, asset managers had just a sea of new things they had to start doing, some of which were warranted, of stress testing, resolution planning, and a series of other regulatory diagnostics. And so all the technology resources and a lot of the R&D, rightfully so in some cases, particularly for GSIBs and GSIFIs, were moved to those activities. But during that same decade was when you have the renaissance of data mobility, mobile communication, speed. So your Ubers and your Airbnbs and all these innovative companies, not in financial services, absolutely flourished and boomed during that same decade. So I think the key thing with regulators and legislators is realizing that that period is now past us. I think we've finished most of that work. So in fact, we've advocated recalibrating a bit of it, but it's still a lost decade. Is how do we have the will to sort of get this technology innovation in the financial system in the way in our own lives we've seen it flourish in the non-financial system. But that 10 or 11 years was a really big deal, because if you think about how you were doing almost all your activities, travel, planning, communication, payments, it's just exploded. And so we've got to get the whole system caught up. And I think the Hill gets that. We've commented on a lot of regulations that are outdated in statute, so there's some statutory work to it, but also the tone at the top of the regulators is very important to set the tone. But they are afraid of the new thing, and it's also gotten intermingled a little bit with sort of a parallel issue, which is social media, the use of data and advertising and privacy of data, which I consider an entirely separate matter,
right.
But it does get somewhat conflated on the Hill as to what rules and how does that relate to financial services, which is something I think both are important, but they're quite distinct in my mind.
Well, one of those
One more shout out too
Absolutely.
to Craig's work on the Treasury papers, because another thing they accomplished was to address the issue, would this new administration be committed to rolling back the reforms? And that put that idea to rest, because it made it very clear that while some better calibration needs to be done based upon better data, the reforms stay. And once that was clarified, it allowed us, in a sense, to move forward now to focus on the tasks ahead. We could stop driving through the rearview mirror and start looking through the front at what's coming at us. And I think those reports are very important to end what had become a very stale debate about reform, rollback of reform. Every time I see the word rollback, it's a political word now. It's not reality. Reality is about calibration and moving forward.
And modernization.
And modernization.
Because the technology is constantly changing. One of the technologies we talk a lot about at the IF is machine learning and AI. We've done a series of reports on machine learning and AML, which if you haven't seen, we'll continue to update them. I was talking with a CEO of a European institution last week. I was in Europe before I went to Florence. And he said, look, I have 1,000 credit officers. I could get that down to 50 with off-the-shelf AI technology. And I said, well, why don't you? And he said, because my supervisor won't let me, because they worry about the black box nature and the idea that you're getting rid of 1,000 credit officers. How could you do it? So we know that the technology is there. We know we can change the nature of at least credit decision-making or AML. There's so many applications. How do we get people, especially in the public sector, comfortable with the technology, which does have a bit of a black box nature to it?
Well, so I literally last night I was getting in my car in the car park, and the person next door to me was one of our best ag analysts at the agency. And she told me she had just used an AI tool that allowed her to draw data out of a certain database that used to take her 2 hours. She said that she got it done in about 15 minutes using a new tool we have. And because I asked her, why you're here so late? And she said, because I got all this data that I wanted, and I actually was doing some really cool analytics with it based on some tools. So it's funny, is it actually making her job easy? She said it was, but yet she was still there at 8 o'clock because I think she was actually kind of grooving on the data. But for someone who's a real analyst that wants to sink their teeth in, the point she was making is these new AI tools allow her to do what she's best at, which is really divining patterns and seeing things in the data. So I think people shouldn't be afraid of this. I mean, I think there will be an absolute change in the workforce, but I think it will move from routine tasks to real value-added tasks. And for those people that really want to do value-added work, it's a great book.
And how are you finding and utilizing and the talent associated with AI? How are you utilizing that at the CFTC? Is that outside vendors? Are you finding internally? How are you finding talent?
We don't have the budget to build bespoke things. We need outside vendors, and there's a lot of really good kit that we've got in our budget to buy, and we're still trying to get resources. It's a never-ending battle, but there's some really good kit. We'll do better and better things when our budget is fully funded.
I look forward to that. Craig, on AI, machine learning?
Well, look, I think in financial services we're behind, and there's a lot of upside. Few banks have really gone entirely to the cloud, and even concepts like AI and machine learning are looked at as experimental, even though they're very mature in many ways. So, I think President Trump signaled that it's a priority. So there's a select committee to study R&D efforts and coordinate public and private sector initiatives. It's also now a key part of our national security strategy, and also the National Council of the American Worker has been tasked with looking at the labor implications. Obviously, we're a leader in the development of these great technology companies, but there is an element of displacing workers, and how do you bring everyone along with this huge boom that we're experiencing? So I think on several fronts the administration's focused on it. But I think particularly in financial services, there's sort of two big elements that needs to be at the center of it. One is digital identity and improving the concept of how do you know who you're dealing with. Some companies that aren't financial can have a very casual business relationship without a high bar of accountability of knowing the customer and responsibilities in areas such as anti-money laundering. But financial services have to follow those rules. So we'd like to see an ongoing effort with the public and private sector to work on digital identity and sort of know who you're dealing with, particularly at the retail level around the world that's uniform. And then the other is the use of data. So, there's now a huge need for maturity around the data aggregation process, giving consumers control over the ownership and movement of their data as they choose, access to that data. But most of the machine learning, artificial intelligence techniques revolve around working with data, and we just need to take the access to data to the next level. It happens again in non-financial sectors, but we have a lot of work to do. So I think digital identity, data aggregation, use of data to really take the next step are probably the two of the key building blocks we'd like to see actually.
You mentioned data. When I first started at the IF about 6 years ago, most of our board meetings were focused on capital, liquidity, resolution, Dodd-Frank, Basel III, FSB. Our last couple of board meetings have been all about data privacy, GDPR, PSD2, who owns the data, who controls it, data rights. Should we have a global data rights convention? The nature has really changed. How do we think about and how should we begin to frame up the issue of data rights, consumer rights, and data control? And as you're thinking about it, let me use one example. We're doing a lot of work on AML, and I'm committed to try to stop the illicit flow of finance. To do so, you've got to share information across jurisdictions. But each jurisdiction has its own set of challenges of sharing data. And in some ways, society is moving in the opposite direction, which is don't share our data. We want data localization. We want data control. So how do we adhere to societal needs of data control, the consumer controls information versus the need for cross-border businesses or even just law enforcement?
Well, I mean, I look at it as you have to really follow the will of the people, and for good or for bad, people now trust the system of using the internet, having access to their data, and many of these services are for free, And at one level, they know they're not really free, that data is used to propel a certain amount of advertising and cross-selling and other factors, but they choose to use it because it's improved their life, the quality of access to services, and cost. So I think we have to just radically embrace that's a reality. And that now technology allows us to digitize finance, so kind of an analog-based finance system, all paper, is also disappearing. So we now have the capability of handling the data in the financial system. So I think it's a matter of having more, one of our ideas is having a more uniform breach law. One of the things that's a little disconcerting is, when there is a data breach, and it can happen, how people are notified, how liability is managed and defined. So we think there's work there. We do think that being proactive on protecting against vulnerabilities is key. Under Senate Bill 2155, we were required to do a vulnerability report back to Congress, which we're submitting shortly. And the Secretary, with the President's Working Group, set out a really extensive vulnerability study among the key regulators to look at shared vulnerabilities across the system. So I think in the financial sector, we can have huge wins in money laundering and other activities if we use this technology. We have to accept the reality of digitization and the consumers and business buy-in of it, and just adapt to a whole new world. So I think it's kind of back to your speech. It's like the Industrial Revolution of sorts. I mean, it's just a new world. You can't contemplate what it should be like because it's nothing like the old world, but you also can't resist it in markets. Trading markets are obviously more mature in evolution than some of these other credit and other markets. And, electronic trading and a lot of things you take for granted in trading, I'd say, is in a more advanced quadrant in this category than some of the more basic business and payment activities. So we're a little behind in those areas relative to trading markets.
Yeah, so let me pivot from a bank focus where you've got concerns about personal information. As a market regulator of markets that are largely institutional, we perhaps are not as focused on the personal information concern. What we're focused on is big market movements and understanding the dynamics of markets. If we can look back for a second to the 2008 financial crisis, at the heart of the crisis was a lack of visibility into counterparty credit exposure of one large financial institution to another. Put aside everything else, at the heart of the crisis was a panic about what the impact of the failure of one institution would mean on another, right? What we hope for is the potential to be able to map those exposures and understand that, right? The G20 Dodd-Frank solution was to create swap data repositories that would gather this data, and then we as regulators would be able to see these connections. We'd be able, in a sense, to do financial cartography through the financial system and understand all the exposures. Unfortunately, good idea, one that I wholeheartedly support, one that I'm as frustrated as can be that 10 years later more progress hasn't been made. And I think one of the reasons more progress has been made is because when it was set up 10 years ago, the regulators said, we got this, we actually don't need the private sector to be terribly involved. I think had they turned to the private sector, to the banks, to the exchanges, and others and said, figure it out, I think we might have been further along.
Right.
But nevertheless, there's meetings still being held to schedule the next meeting. I mean, it's become a global bureaucracy. We haven't sat around and waited for that to resolve itself, although we've been one of the big proponents of moving it forward at the CFTC. Because another reform was to bring more swaps trading into clearinghouses. Most of that is coalesced at the London Clearinghouse, of which the CFTC is a primary regulator. Now 80% of interest rate swaps are cleared at the London Clearinghouse, which we regulate. We have all that data. 80% of the CDS market is now cleared by ICE Clear Credit, which we regulate. We have all that data. So while the swap data repository idea is still moving along and it's making progress, we haven't sat around and waited. We get that data. We are now mapping those connections, those that we're doing financial cartography in the clearing ecosystem, understanding the connections. And that's where we need to go. And I'll just end on one other thing. One of the concerns that's been raised in Congress and others right now is about leveraged lending. We're using the data sets we have to understand how, when leveraged lenders lend, how do they offset that risk in the derivative market? You'll see numbers about the hundreds of billions in leveraged loans. Well, what we're doing is saying, well, but how much of that has been offset in our wholesale derivative markets? How much of that is collateralized with margin? How much of that is really at risk? One of the big things we did with the wholehearted support of FSOC and Treasury is to move beyond this notional calculation of derivatives exposure, which is a total misleading number, but it's useful politically to drive an agenda. But what we've done is taken that number and in a sense distilled it down to true net exposure, net of margin, net of offsets. And so when you look at that, you take a $180 trillion interest rate exposure notional amount of US banks, it nets down to a $17 trillion number, a number that looks more like the Treasury market or the corporate loan market. Suddenly it's a number we can understand. That's the real risk exposure of derivatives. It's not in the hundreds of trillions. And so the point about data is we're using the data sets we have, and we want to use more, to actually try to understand what real risk exposures are in the system. And I think we're doing a very good job at that, and we've got a lot more to come.
You know, the way you described it, and we're out of time, but I just want one last question, and that's on market fragmentation. We have an event in Tokyo next week alongside the G20, where market fragmentation is one of our top issues, and it has been for the Japanese who are chairing the G20. We see new examples of fragmentation every day in various jurisdictions around the world, ring fencing in a variety of ways, capital liquidity, technology. How do you think about the trend lines of fragmentation from your perspective, and how do we counter this notion of ring fencing?
So I'll be quick. We at the CFTC just co-chaired IOSCO's report on fragmentation with Japan, and that will be delivered at the G20 meeting in June. It's a very good paper. It really acknowledges fragmentation that's occurred in the markets. Just to go back to that point about counterparty credit exposure, there's no point in just measuring the exposure of US banks to US banks. We have to look at this across the global ecosystem. It's a global market. So we need to have, and this answers your earlier question, we've got to have data flowing across borders, and especially institutional information about financial exposure, so that we can then map it and we can then understand the exposures in a way we didn't 10 years ago, which led to a financial panic. Last point. We now know that the total CDS written on Lehman Brothers was not $400 billion, which is what it was estimated to be in the year 2008, but under $8 billion, netted down. If we knew that the full exposure of Lehman was $8 billion in 2008, the regulatory and the policy response to the crisis could have been entirely different than it was. The lack of data, the lack of analysis, perhaps created a crisis response that would have been much better today. If we had the blockchain then, if all trades were on a blockchain, and we could have used that to net down the exposures, it could have been a very different situation.
So I think the dilemma is we have excessive fragmentation of our regulatory system, and it's just hard to encourage innovation in that system because the multiple regulators with their traditional remits defined around traditional companies have a hard time coordinating, adapting to these new technologies and how they cross over the existing lines. So one of our biggest recommendations is just if everyone could just do everything once rather than multiple overlaps and redundant exams, that would improve the entire regulatory system. But it also speaks to the problem of innovation. You know, we have to allow innovation, and people refer to regulatory sandbox. I'm sure we'll explore that today, but that concept is really how do you sort of let someone experiment or explore an idea before they adopt it permanently and it becomes a permanent rule. But if you have overlap, you have multiple regulators that have to reach that conclusion. So we're for federal charters such as the OCC charter, and the level of state regulation creates a very high hurdle if you have to be licensed in 50+ jurisdictions. So I think that's our issue here in the US. Other countries do not have that, so you see certain things moving quicker. But I think you know, the US has so much to be proud of in our technology and the leading companies around the world. If we can afford pitfalls such as inappropriate data localization and other tax regimes, and you know, I think the US can thrive here and abroad. So we're in a very strong position, but our regulatory system is probably not as aligned towards innovation. If you talk to young companies that have gone global, they will put us, you know, really low on the list of sort of the ease of launching here versus their ease of launching in other jurisdictions. So I think it's one of our challenges.
Gentlemen, thank you so much. Thank you for coming here today and getting us started, but thank you for your public service. You know, Washington gets a bit of a black eye in this day and age, and the so-called death of expertise, but the two of you have done a remarkable job. You have brought intelligence and patience and thoughtfulness and real-world experience, both of you. You know, you've really done a remarkable job. And I can say that at the end of your tenure, so I'm not asking for anything or want anything from you, but I just want to thank you as a taxpayer for all that you've done. I hope there are more people like you that enter the administration in the years to come. Thank you very much. Ladies and gentlemen.